I have spent decades criticizing gold as an investment. I have called it an unproductive asset. I have said that if you took all the gold in the world and melted it down, you would have a cube about 68 feet on each side, worth around $10 trillion. And that cube would just sit there doing nothing, producing nothing, while the same money invested in productive businesses would generate earnings and dividends and growth year after year. I have pointed out that gold does not reproduce, it does not pay dividends, it does not innovate or expand. If you own an ounce of gold today, in 100 years, you will still own exactly 1 ounce of gold. Meanwhile, a great business will have grown, reinvested its earnings, expanded its operations, and compounded its value many times over. I have watched gold investors wait for calamity, convinced that the financial system would collapse, that currencies would become worthless, that their gold would save them. And I've watched them earn poor returns over decades while productive assets outperform by enormous margins. All of this remains true. Gold is generally a poor investment compared to productive businesses. For most people, most of the time, owning stocks in great companies will produce far better results than owning gold. And yet, today, I'm going to tell you about the only gold position I would ever consider owning. Not physical gold bars sitting in a vault. Not a gold ETF that tracks the price of bullion. Something different, something that addresses my core objection to gold while still providing exposure to gold prices when that exposure might actually be valuable. This is not a reversal of my views. It is a refinement. It is recognizing that under specific circumstances, a specific type of gold exposure can make sense even for investors who share my skepticism about gold as a long-term store of value. Let me start by explaining my objections to gold in more detail, because understanding why I generally avoid gold is essential to understanding why this one exception makes sense. My fundamental objection to gold is that it produces nothing. When I buy a share of stock, I am buying partial ownership of a business. That business has employees who come to work every day. It has factories that produce goods or offices that provide services. It has customers who pay money for what the business offers. It generates revenue, earns profits, and can distribute those profits to me as dividends or reinvest them to grow even more valuable. Over time, productive businesses create wealth. They take raw materials and labor and capital and transform them into goods and services worth more than the inputs. This wealth creation is the engine of economic progress. And as a shareholder, I participate in that wealth creation. Gold creates nothing. An ounce of gold produces no earnings. It employs no workers. It serves no customers. It just sits there, shiny and inert. Its only value comes from what someone else is willing to pay for it in the future. And that future price depends entirely on supply and demand, on psychology and sentiment, not on any underlying productive activity. This is why I've said that gold is essentially a bet on fear. People buy gold because they are afraid of something, afraid of inflation, afraid of currency devaluation, afraid of financial collapse, afraid of war or chaos or calamity. Gold is an insurance policy against disaster, and like most insurance policies, it costs money to hold and produces negative expected returns over long periods when the disaster does not occur. The historical data supports this view. Over the past century, stocks have compounded at around 10% per year, including dividends. Gold has compounded around 5% per year, roughly matching inflation, but providing no real return. $1 invested in stocks in 1920 would be worth tens of thousands of dollars today. $1 invested in gold would be worth perhaps $100. The difference is staggering, and this makes sense when you think about what you are buying. With stocks, you are buying a share of all the innovation, all the hard work, all the productivity growth of the American economy. With gold, you are buying a metal that has been valued for thousands of years but produces nothing. Now, let me tell you why, despite all of this, there is one gold position I would consider owning. The position is not gold itself. It is shares in gold mining companies, specifically shares in the highest quality gold miners, the companies with the best assets, the lowest costs, the strongest balance sheets, and the most capable management teams. This might seem like a contradiction. If I do not like gold, why would I like companies that dig gold out of the ground? But there is an important difference between owning gold and owning gold mining companies that resolves my core objection. Gold mining companies are productive businesses. They employ workers. They operate mines. They invest in exploration and development. They generate revenue and earnings. They pay dividends. They can grow and compound their value over time. They are not inert lumps of metal sitting in a vault. They are operating enterprises that create value through their activities. When you own a gold mining company, you own a business. Yes, the fortunes of that business are tied to the price of gold. If gold prices fall, the company's profits decline. If gold prices rise, profits increase. But you are still owning a productive enterprise, not a non-productive asset. This distinction matters enormously for long-term returns. A gold mining company can increase its production over time by developing new mines and expanding existing ones. It can reduce its costs through operational improvements and technological innovation. It can return capital to shareholders through dividends and buybacks. It can compound its value in ways that physical gold cannot. Let me give you a concrete example. Imagine gold stays flat at $2,000 per ounce for 20 years. Physical gold produces zero return. You end with exactly what you started with. But a well-run gold mining company might produce gold at a cost of $1,000 per ounce, earning $1,000 per ounce in profit. It might grow its production from 1 million ounces per year to 2 million ounces per year through smart investments in new mines. It might pay dividends to shareholders while also reinvesting in its business. Even with flat gold prices, such a company could double or triple its earnings over 20 years. Its stock price would likely follow, rewarding shareholders handsomely. This is the magic of owning a business versus owning a commodity. The business can grow and improve and compound. The commodity just sits there. Of course, gold mining companies face risks that physical gold does not. Mines can flood or collapse. Labor disputes can halt production. Governments can change tax policies or royalty rates. Management can make poor capital allocation decisions. Exploration can fail. Costs can rise unexpectedly. All of these risks are real and must be considered. But these are the risks of any business investment. I face similar risks when I invest in banks or insurers or manufacturers. The question is whether the potential rewards justify the risks. And for the best gold mining companies, I believe they do under certain circumstances. Let me now discuss those circumstances. When does it make sense to own gold mining stocks? The first circumstance is when gold prices are depressed relative to production costs. Gold mining is a cyclical business with dramatic swings in profitability. When gold prices are high and production costs are low, miners earn fat profits and their stocks soar. When gold prices are low and costs are high, miners barely break even or lose money and their stocks collapse. The best time to buy gold mining stocks is when the industry is in the depths of despair, when gold prices have been declining for years, when miners have been shutting down high-cost mines and laying off workers, when exploration budgets have been slashed to nothing, when the stocks have fallen 80 or 90% from their peaks, and everyone has given up on the sector. At those moments, you can buy gold mining businesses at extraordinary discounts to their underlying value. You are getting productive assets for pennies on the dollar. And when the cycle eventually turns, when gold prices recover and the surviving miners return to profitability, the returns can be spectacular. I have seen this pattern play out multiple times in my career. In the late 1990s and early 2000s, gold prices were depressed, having fallen steadily from their 1980 peak. Gold mining stocks were dirt cheap. Investors who bought quality miners at those lows and held through the subsequent bull market earned returns of 10, 20, even 30 times their investment. The same pattern occurred in 2015 and 2016. Gold prices had fallen from their 2011 peak of around $1,900 per ounce to around $1,100 per ounce. Mining stocks had collapsed. Many companies were trading below the value of the gold in the ground at their mines. Patient investors who bought quality miners at those lows earned spectacular returns as gold recovered over the following years. This cyclical opportunity is the primary circumstance when I would consider owning gold mining stocks. Not as a permanent holding, not as a core position, but as a contrarian investment when the sector is maximally out of favor and valuations are compelling. The second circumstance is when you want specific hedging against monetary chaos without sacrificing all potential for productive returns. There are times when reasonable people can worry about the stability of the financial system, when government debts are soaring to unprecedented levels, when central banks are printing money at extraordinary rates, when inflation is accelerating or threatening to accelerate, when geopolitical tensions are rising, when the global order seems fragile. During such times, some allocation to assets that might benefit from monetary disruption can be prudent. Physical gold serves this purpose but produces no return while you wait. Gold mining stocks offer a middle path. They provide exposure to rising gold prices if monetary chaos does occur, but they also provide the productive characteristics of a business, generating earnings and potentially paying dividends even if gold prices stay flat. If your concern is inflation, gold mining stocks are interesting because their revenues rise with gold prices, which tend to rise with inflation. While many of their costs are relatively fixed in nominal terms, this creates operating leverage that can amplify returns during inflationary periods. If your concern is currency devaluation, gold mining stocks provide exposure to a hard asset whose value is recognized globally, independent of any particular currency. The mines themselves are real physical assets that cannot be inflated away. I want to be clear that I do not recommend large allocations to gold mining stocks under any circumstances, even in the scenarios I have described. I would limit exposure to perhaps 5% of a portfolio, maybe 10% at the absolute maximum during periods of maximum opportunity. Gold mining stocks are volatile and risky and should never represent a core holding for most investors. But a modest allocation under the right circumstances can provide valuable diversification and optionality without the dead weight of owning non-productive physical gold. Let me now discuss what I look for in a gold mining company, because not all miners are created equal. In fact, most gold mining companies are terrible investments that destroy shareholder value over time. The key is identifying the exceptional operators who can generate returns through cycles. The first thing I look for is low-cost production. Gold mining economics are simple. You dig gold out of the ground and sell it. Your profit is the difference between the sale price and your production cost. Companies with lower production costs earn more profit at any given gold price and can survive when gold prices decline. I want to own miners whose all-in sustaining costs are in the bottom quartile of the industry. These companies can remain profitable even when gold prices are depressed. They can continue investing in their mines while higher-cost competitors are cutting back. They emerge from downturns stronger while weaker competitors have been weakened or eliminated. The metric I focus on is all-in sustaining cost per ounce. This includes direct mining costs, processing costs, overhead, sustaining capital expenditures, and exploration costs needed to maintain production. The best miners produce gold for under $1,000 per ounce. Marginal miners produce at $1,400 or $1,500 per ounce or higher. The difference in profitability is enormous. The second thing I look for is long life, high quality reserves. A gold mine is a depleting asset. Every ounce you produce is one less ounce in the ground. To maintain or grow production, you must continually find and develop new reserves. I want to own miners with decades of production ahead of them at current rates. This means large reserve bases measured in tens of millions of ounces. It means ongoing exploration programs that are adding reserves faster than production is depleting them. It means optionality to expand production if gold prices rise. Quality of reserves matters as much as quantity. I prefer underground reserves in stable jurisdictions to open pit reserves in politically risky countries. I prefer reserves with high gold grades to low-grade deposits that require moving enormous amounts of rock. I prefer reserves with straightforward metallurgy to complex deposits requiring expensive processing. The third thing I look for is a strong balance sheet. Gold mining is cyclical and volatile. Companies with too much debt can be wiped out during downturns even if their underlying assets are sound. I want to own miners with modest debt levels relative to their cash flow, ideally with net cash positions that give them financial flexibility. A strong balance sheet allows a miner to weather difficult periods without selling assets at distressed prices or diluting shareholders with emergency equity raises. It allows the company to make opportunistic acquisitions when weaker competitors are struggling. It provides the foundation for returning capital to shareholders through dividends and buybacks when times are good. The fourth thing I look for is capable and honest management. Mining is an operationally complex business with many opportunities for things to go wrong. Good management can navigate these challenges and create value for shareholders. Bad management can destroy even the best assets through poor decisions. I look for management teams with track records of operational excellence, teams that consistently meet or exceed production and cost guidance, teams that have successfully developed new mines on time and on budget, teams that have made smart capital allocation decisions, avoiding the empire-building acquisitions that have destroyed value at many mining companies. I also look for alignment of interests. Management should own meaningful stakes in the company so their wealth rises and falls with shareholder returns. Compensation should be tied to metrics that matter for long-term value creation, not just to gold prices or production volumes that are outside management's control. The fifth thing I look for is reasonable valuation. Even the best gold mining company is a poor investment if you pay too much for it. I want to buy miners at discounts to their underlying asset value, measured by the net present value of their reserves at reasonable gold price assumptions. During periods of sector distress, quality miners can trade at significant discounts to net asset value. During periods of euphoria, they can trade at premiums that make no sense. I want to buy during distress, not euphoria. I also compare valuations across the sector. If one quality miner trades at half the valuation multiple of another quality miner with similar characteristics, I want to understand why. Sometimes there are good reasons. Sometimes it is just market inefficiency that creates opportunity. Let me give you a hypothetical example of the kind of gold mining company I might consider owning. Imagine a company with the following characteristics. It operates 3 large underground gold mines in stable jurisdictions like Canada and Australia. Its all-in sustaining cost is $850 per ounce, putting it in the lowest cost decile of the industry. It has proven and probable reserves of 40 million ounces, representing over 20 years of production at current rates. Its balance sheet shows $2 billion of net cash with 0 debt. Management has been in place for 15 years and has consistently delivered operational excellence with production and cost guidance met or exceeded every year. The CEO owns 5% of the company. Now imagine that gold prices have declined 30% over the past 3 years and mining stocks have been hammered. This company's stock has fallen 50% from its peak. It now trades at 3 times cash flow, a 40% discount to net asset value at current gold prices, and a 60% discount to net asset value at long-term average gold prices. That is a company I might consider owning. It is a productive business with all the characteristics I want. Its valuation is depressed because of sector-wide pessimism, not because of anything wrong with the company. If gold prices recover, or even just stabilize, the stock has significant upside. And even if gold prices stay depressed, the company will survive and continue paying dividends while waiting for better times. This is very different from buying physical gold or a gold ETF. With physical gold, I am just betting on the price. With this company, I am buying a productive business at a discount to its value, run by capable people with the potential to compound my investment over time, regardless of gold prices. Let me now address some common questions and objections about this approach. First, why not just buy physical gold or a gold ETF if I want gold exposure? The answer is what I have already explained. Physical gold produces nothing. It has no earnings, no dividends, no growth potential. Owning it is a pure bet on price appreciation driven by supply and demand and sentiment. Gold mining stocks, by contrast, are productive businesses that can grow and compound value even if gold prices are flat. Second, are not gold mining stocks more volatile than physical gold? Yes, they are. Gold mining stocks have operating leverage that amplifies gold price movements. If gold rises 10%, a miner's profits might rise 30 or 40%, and its stock might rise even more. Conversely, if gold falls 10%, profits might fall 30 or 40%. This volatility cuts both ways. For investors who cannot stomach volatility, gold mining stocks are not appropriate. But for investors with long time horizons and strong stomachs, the volatility can be a feature rather than a bug. It creates opportunities to buy quality companies at distressed prices when the sector is out of favor. Third, how do I deal with the geopolitical risks of mining? Many gold deposits are located in countries with unstable governments, weak rule of law, or histories of resource nationalism. Mines have been expropriated, taxes have been raised unexpectedly, permits have been revoked arbitrarily. My answer is to focus on miners with assets in stable jurisdictions. There is enough gold in Canada, the United States, Australia, and other countries with reliable legal systems that you do not need to take on emerging market political risk. Yes, mines in these jurisdictions may have higher labor and regulatory costs, but those costs are worth paying to avoid the tail risk of expropriation or civil unrest. Fourth, what about the environmental and social issues associated with mining? Gold mining, like all mining, has environmental impacts. There are legitimate concerns about water use, habitat destruction, and community relations. These concerns are real and must be taken seriously. I look for miners with strong environmental and social track records, companies that operate responsibly, engage constructively with communities, and invest in environmental protection. Not because I am naive about the challenges of mining, but because companies that manage these issues well tend to have more sustainable operations and face less regulatory and reputational risk. Fifth, how large a position would I take? As I mentioned earlier, gold mining stocks should be a small allocation even under the most favorable circumstances, perhaps 5% of a portfolio during periods of maximum opportunity, never more than 10%, and often 0% when the sector is expensive or when better opportunities exist elsewhere. This is not a core holding. It is a tactical allocation to take advantage of specific opportunities when they arise. Most of the time, most investors should have zero exposure to gold mining stocks and focus their portfolios on productive businesses in other sectors. Let me now tell you a story that illustrates why this approach can work. In 2015, the gold mining sector was in terrible shape. Gold prices had fallen from their 2011 peak of over $1,900 per ounce to around $1,100 per ounce. Many miners were losing money. Exploration budgets had been slashed. Some companies were on the verge of bankruptcy. Mining stocks had fallen 80% or more from their peaks. At that time, if you had bought shares in a well-managed, low-cost gold miner, you would have paid a significant discount to net asset value. You would have bought a productive business at a bargain price.
Over the following 5 years, gold prices recovered to over $2,000 per ounce. The quality miners that survived the downturn saw their profits soar.
Their stocks rose 4, 5, 6 times or more from the 2015 lows. Investors who had the courage to buy during the darkest days earned spectacular returns. Those returns came not just from gold price appreciation, but from the business characteristics of the miners themselves. They grew production, they reduced costs, they paid off debt, they increased dividends, they acquired assets from struggling competitors at bargain prices. The businesses improved even as gold prices recovered, amplifying the returns for shareholders. Compare this to what happened with physical gold over the same period. Gold prices roughly doubled from their 2015 lows to their subsequent highs. A nice return, but far less than the returns from quality mining stocks. And physical gold produced no income along the way, no dividends, no operational improvements. It just sat there, inert. This comparison illustrates the power of owning a business versus owning a commodity. The business can compound, the commodity cannot.
Let me also discuss when I would sell gold mining stocks, because knowing when to exit is as important as knowing when to enter.
I would sell when valuations become excessive, when mining stocks are trading at premiums to net asset value, when sentiment has shifted from despair to euphoria, when everyone is convinced that gold prices will rise forever and miners are the best investment in the world. That is when I would reduce or eliminate my position. I would also sell if the fundamental characteristics of a company deteriorated. If management made poor capital allocation decisions, overpaying for acquisitions or investing in marginal projects, if costs rose significantly for reasons that seemed permanent rather than temporary, if the balance sheet weakened to the point where financial flexibility was impaired, and I would sell if better opportunities emerged elsewhere. Gold mining stocks compete with every other investment for a place in my portfolio. If I can find better risk-adjusted returns in other sectors, I would reallocate capital accordingly. Gold mining is not a religion. It is a business investment that must earn its place against all alternatives. Let me close with some thoughts on how this fits into a broader investment philosophy. I am not a gold bug. I do not believe that gold is the ultimate store of value or that the financial system is on the verge of collapse. I remain fundamentally bullish on productive businesses and the American economy. The core of my portfolio will always be ownership of great companies that grow and compound value over time. But I am also a pragmatist. I recognize that markets are cyclical and that opportunities arise in unexpected places. I recognize that diversification can reduce risk without sacrificing return when done thoughtfully. And I recognize that gold mining stocks, during periods of maximum pessimism, can offer compelling value as productive businesses with exposure to an asset class that provides some diversification benefits.
The key insight is that gold mining stocks are businesses, not just commodity bets. They employ workers, operate mines, generate earnings, pay dividends, and can grow over time.
They address my core objection to gold, which is its non-productive nature, while still providing exposure to gold prices when that exposure might be valuable. This does not mean I recommend gold mining stocks for everyone. Most investors are better served by owning diversified portfolios of high-quality businesses across many sectors. Gold mining is a specialized area with significant risks and requires knowledge and attention that most investors cannot provide. But for investors who understand the sector, who can identify quality miners, who can buy at attractive valuations during periods of distress, and who can tolerate the volatility that comes with the territory, gold mining stocks offer a way to own gold exposure that actually makes sense from a business perspective. That is the only gold position I would ever consider owning. Not gold bars, not gold ETFs, but shares in the best gold mining businesses bought at the right prices during the right circumstances. It is a narrow opportunity, available only occasionally, and appropriate only for investors with the right knowledge and temperament. But when the circumstances align, it can be a rewarding place to put a small portion of a portfolio. I have spent my career buying productive businesses at reasonable prices and holding them for the long term. That remains my core approach. Gold mining stocks, when the opportunity is right, fit within that framework. They are productive businesses. They can be bought at reasonable or even bargain prices, and they can compound value over time. That is what makes them the only gold position I would ever consider owning. Not because gold itself has changed. It remains an unproductive asset that produces nothing. But because gold mining companies are different. They are businesses, and buying good businesses at good prices is what investing is all about. If you take nothing else from this discussion, take this. The form of your investment matters as much as the asset class. Owning physical gold means owning something that produces nothing and can only increase in value if someone else is willing to pay more for it later. Owning gold mining companies means owning businesses that can grow, improve, and compound value over time. The distinction is fundamental, and it is why I would consider one but never the other.
The opportunity to buy quality gold miners at attractive prices does not come often. It requires patience to wait for the right moment, knowledge to identify the right companies,
and courage to buy when everyone else is selling.
But for investors with these qualities, gold mining stocks offer something that physical gold never can: the chance to own a productive business while still gaining exposure to gold prices.
That is the only gold position I would ever consider owning. And now you understand why. But let me go deeper on several of these points, because the details matter enormously when you are actually putting money to work in this sector. Let me start by discussing the economics of gold mining in more detail, because understanding these economics is essential to identifying which companies are truly exceptional. Gold mining economics start with geology. Not all gold deposits are created equal. Some deposits have high grades, meaning each ton of rock contains a lot of gold. Others have low grades, requiring you to process enormous amounts of rock to extract a relatively small amount of gold. The difference in economics is staggering. A high-grade underground mine might have ore grades of 10 or 15 grams of gold per ton of rock. A low-grade open-pit mine might have ore grades of 1 gram per ton or even less. To produce the same amount of gold, the low-grade mine must move 10 or 15 times as much rock. That means 10 or 15 times as much equipment, 10 or 15 times as much fuel, 10 or 15 times as much labor for the mining itself. This is why grade is so important to gold mining economics. Higher grade deposits tend to have lower production costs because you are extracting more gold from less rock. When I evaluate gold mining companies, I pay close attention to the grade of their reserves and how that grade compares to the industry average. But grade is not everything. The nature of the deposit matters too. Some deposits are amenable to open pit mining, where you remove layers of rock from the surface in a series of expanding benches. Open pit mining is generally lower cost per ton of rock moved, but requires removing large amounts of waste rock to access the ore. Other deposits are better suited to underground mining, where you sink shafts and tunnels to access ore bodies below the surface. Underground mining is generally higher cost per ton, but allows you to target the ore more precisely, reducing the amount of waste rock you must move. The best deposits are often those that can be mined using both methods in sequence. You start with open pit mining to access the near surface ore, then transition to underground mining to access deeper ore bodies. This combination can extend mine life significantly and optimize overall economics. Metallurgy is another critical factor. Once you have extracted ore from the ground, you must process it to separate the gold from the rock. Some ore is easy to process using conventional methods like crushing, grinding, and cyanide leaching. Other ore is refractory, meaning the gold is locked in sulfide minerals that must be oxidized before the gold can be extracted. Refractory ore requires additional processing steps that add significant cost. When I evaluate gold mining companies, I want to understand the metallurgy of their deposits. Simple metallurgy means lower processing costs and fewer things that can go wrong. Complex metallurgy adds cost, risk, and operational challenges. Infrastructure is another consideration. A deposit in a remote location with no roads, no power, and no water supply will cost far more to develop than a deposit near existing infrastructure. The capital cost to build a mine in the middle of nowhere can be billions of dollars versus hundreds of millions for a mine near civilization. Operating costs are also affected by infrastructure. Power is a major cost for gold mines, and mines that can access grid electricity pay far less than mines that must generate their own power using diesel generators. Water availability, labor markets, supply chain, logistics, all of these infrastructure factors affect the economics of a mining operation. Jurisdiction matters enormously, and I want to spend more time on this point because it is often underappreciated by investors. Gold deposits exist all over the world, including in countries with weak rule of law, corrupt governments, and histories of resource nationalism. Some of the richest deposits are in places like the Democratic Republic of Congo, Papua New Guinea, or various Central Asian republics. The temptation for mining companies is to develop these deposits because the geology is attractive, accepting the political risk as the price of admission. I avoid this temptation. The best geology in the world is worthless if the government can expropriate your mine, raise taxes to confiscatory levels, or create regulatory obstacles that make operations impossible. I have seen it happen too many times. A company invests billions developing a mine in a politically risky jurisdiction, only to have the government change the rules after the mine is built and the capital is sunk. My preference is overwhelming for mines in jurisdictions with strong rule of law, independent judiciaries, stable tax regimes, and long histories of respecting property rights. This means primarily Canada, the United States, and Australia. These countries have higher labor costs and more stringent environmental regulations, but those costs are worth paying to avoid political risk. I would rather own a higher cost mine in Canada than a lower cost mine in a politically unstable country. The Canadian mine might earn thinner margins, but those margins are reliable. The foreign mine might show spectacular economics on paper, but those economics can evaporate overnight if the political situation changes. Some investors disagree with this approach. They argue that the higher returns available in riskier jurisdictions compensate for the political risk. They point to companies that have operated successfully in challenging environments for decades, and they are not entirely wrong. Some companies have generated excellent returns from mines in difficult places. But the asymmetry concerns me. The upside from investing in risky jurisdictions is higher returns. The downside is total loss if something goes wrong. I prefer to avoid that asymmetry and accept somewhat lower returns in exchange for much lower risk of catastrophic loss. Now let me discuss the capital cycle in gold mining, because understanding this cycle is essential to timing your investments effectively. Gold mining is an intensely cyclical business, and the cycles are driven by the interaction of gold prices, production costs, and capital investment. When gold prices are high and production costs are low, gold mining is extraordinarily profitable. Companies generate enormous cash flows, they pay dividends, they buy back stock. They also invest heavily in new mines and expansions of existing mines. Exploration budgets soar as companies search for new deposits. Construction activity accelerates as companies race to bring new production online. This investment boom eventually leads to excess capacity. New mines come online just as gold prices are peaking or starting to decline. Supply increases at the same time demand is weakening. Gold prices fall, often dramatically. As gold prices fall, the economics of gold mining deteriorate. Higher cost mines become unprofitable and are shut down. Exploration budgets are slashed. Construction projects are delayed or canceled. Workers are laid off. Companies with too much debt face financial distress or bankruptcy. This contraction eventually sets the stage for the next upturn. Supply falls as mines are closed and new projects are canceled. Demand stabilizes or recovers. The balance shifts and gold prices begin to rise again. And the cycle repeats. The key insight for investors is that the best time to buy gold mining stocks is during the contraction phase, when pessimism is greatest and valuations are lowest. At these moments, you can buy productive assets at deep discounts to replacement cost. You are buying mines that cost billions to develop for a fraction of that cost in the stock market. Conversely, the worst time to buy gold mining stocks is during the expansion phase, when optimism is greatest and valuations are highest. At these moments, you are paying premium prices for assets that will likely generate disappointing returns as the cycle turns. Timing the cycle perfectly is impossible, but recognizing where we are in the cycle is not that difficult. When gold prices have been rising for years, when mining stocks have been outperforming, when exploration budgets are at record highs, when new projects are being announced regularly, we are likely in the expansion phase. Caution is warranted. When gold prices have been falling for years, when mining stocks have been crushed, when exploration budgets have been slashed, when companies are shutting mines and laying off workers, we are likely in the contraction phase. Opportunity beckons for those with the courage to buy. Let me now discuss how to analyze individual gold mining companies once you have identified a favorable point in the cycle. The starting point is the reserve and resource statement. Every gold mining company publishes estimates of the gold contained in their deposits, categorized by the level of geological confidence. Proven reserves are the most certain, based on detailed drilling and analysis. Probable reserves are somewhat less certain, but still reliable enough to support mining plans. Measured, indicated, and inferred resources represent progressively less certain estimates. I focus primarily on proven and probable reserves, which represent the gold that can be extracted with current technology at current prices with reasonable confidence. The size of these reserves tells you how much gold the company can produce and for how long. Larger reserves provide more optionality and longer mine lives. But reserve size alone is not enough. You must also understand the quality of those reserves, the grade, the metallurgy, the mining method, the infrastructure requirements, the jurisdictional risks. A company with smaller but higher quality reserves in stable jurisdictions may be a better investment than a company with larger but lower quality reserves in risky places. The next step is to analyze production costs. The industry standard metric is all-in sustaining cost per ounce, which includes all the costs required to maintain current production levels. This metric allows you to compare costs across companies and understand which companies will remain profitable at various gold prices. I want to see production costs that are significantly below current gold prices, providing a margin of safety if gold prices decline. Companies with costs at or above current gold prices are vulnerable to losses if gold weakens even modestly.
These companies are appropriate only for investors making aggressive bets on rising gold prices. Balance sheet strength is critical. I examine debt levels, cash positions, credit facilities, and debt maturities. Companies with too much debt are vulnerable during downturns and may be forced to sell assets or dilute shareholders at the worst possible times. Companies with strong balance sheets can weather downturns and take advantage of opportunities that distress creates. Free cash flow generation matters enormously. Is the company generating more cash than it is spending? Can it fund its capital expenditures from operating cash flow, or must it rely on external financing? Companies that consistently generate free cash flow can return capital to shareholders and self-fund growth. Companies that consistently consume cash are dependent on the kindness of capital markets. Management quality is harder to assess, but no less important. I look at track records. Has management delivered on production and cost guidance historically? Has it made smart capital allocation decisions, avoiding overpriced acquisitions and value-destroying projects? Does management own meaningful stakes in the company, aligning their interests with shareholders? I also pay attention to how management communicates. Do they acknowledge challenges honestly, or do they spin everything positively? Are their presentations filled with realistic assessments or aspirational projections? Companies that consistently overpromise and underdeliver are telling you something about management quality. Valuation is the final piece. I compare the current stock price to various measures of underlying value. Price to net asset value tells you how the market is valuing the company's reserves. Price to cash flow tells you how expensive the company is relative to its current earnings power. Price to book value provides another perspective. I also compare valuations across the sector. If two companies have similar assets, similar costs, similar balance sheets, and similar management quality, but one trades at half the valuation of the other, the discrepancy demands explanation. Sometimes there are good reasons for valuation differences. Sometimes there are not, and the cheaper company represents better value. Let me share some thoughts on portfolio construction and position sizing for gold mining investments. As I mentioned earlier, gold mining stocks should represent a small allocation even under the most favorable circumstances. This is not because the returns are necessarily lower than other investments. In fact, returns from gold mining stocks bought at cycle lows can be spectacular. It is because of the volatility and risk characteristics of the sector. Gold mining stocks can decline 50, 60, 70% or more during downturns. Even the best companies with the strongest balance sheets experience dramatic price declines when the sector is out of favor. Investors who concentrate their portfolios in gold mining stocks can experience devastating losses that take years to recover from. By limiting gold mining exposure to 5% or so of a portfolio, you can participate in the upside during favorable periods while containing the damage during unfavorable periods. If gold mining stocks double, a 5% allocation contributes 5 percentage points to your overall return. If they fall by half, you lose only 2.5 percentage points. The asymmetry is manageable. Within your gold mining allocation, diversification is also important. Do not put everything into a single company, no matter how attractive it appears. Operational problems at individual mines can devastate stock prices, even for well-managed companies. A diversified portfolio of 3 to 5 quality miners provides exposure to the sector while reducing single company risk. I also think about correlations with the rest of my portfolio. Gold mining stocks have historically had low or negative correlations with the broader stock market during periods of financial stress. This makes them potentially valuable as portfolio diversifiers, providing returns when other assets are struggling. But correlations are not stable. During normal times, gold mining stocks often move with the broader market. The diversification benefit appears primarily during crisis periods, which is exactly when you most need it. This is why a modest allocation to gold mining stocks can improve portfolio characteristics even if expected returns are similar to other investments. Let me now discuss some common mistakes that investors make in gold mining and how to avoid them. The first mistake is buying at the wrong time. Investors get excited about gold mining when gold prices are soaring and mining stocks are making headlines. They pile in at exactly the wrong moment, when valuations are high and expected returns are low. Then they sell in disgust years later when prices have collapsed, locking in losses at the worst possible time. The cure for this mistake is discipline. Develop a framework for evaluating when gold mining stocks are attractive and stick to it regardless of market sentiment.
Buy when valuations are low and the sector is out of favor. Sell when valuations are high and the sector is popular. This is simple to describe, but emotionally difficult to execute. The second mistake is buying low-quality companies. Not all gold mining companies are good investments. Many are poorly managed, with high costs, weak balance sheets, and assets in risky jurisdictions. These companies may generate spectacular returns during bull markets, but give back all those gains and more during bear markets. The cure for this mistake is rigorous analysis, focus on quality companies with low costs, strong balance sheets, excellent assets, and capable management. Avoid the temptation to buy cheap companies in the hopes that rising gold prices will bail them out. Quality companies will outperform through cycles. The third mistake is overconcentration. Some investors become gold bugs, convinced that monetary collapse is imminent and gold is the only safe asset. They put half or more of their portfolios into gold mining stocks and suffer devastating losses when the sector declines. The cure for this mistake is diversification and humility. No one can predict the future with certainty. Gold prices might rise or they might fall. The financial system might collapse or it might muddle through. A modest allocation to gold mining stocks allows you to benefit if gold prices rise without betting everything on that outcome.
The fourth mistake is ignoring the business fundamentals. Some investors treat gold mining stocks as leveraged bets on gold prices without understanding the underlying businesses.
They buy without analyzing costs, reserves, balance sheets, or management. They are surprised when their stocks underperform gold prices during bull markets or decline more than gold prices during bear markets. The cure for this mistake is fundamental analysis. Treat gold mining stocks as business investments, not commodity bets. Understand the assets, the costs, the management, the valuation. Buy companies that would be good investments even if gold prices stayed flat, and let gold price appreciation provide additional upside.
Let me close with a few final thoughts on why this approach to gold exposure makes sense within a broader investment philosophy focused on productive businesses.
I have built my career on the principle that owning productive businesses is the best way to build wealth over time. Businesses create value through their operations. They employ workers, serve customers, generate profits, and compound those profits through reinvestment. This wealth creation is the foundation of long-term investment returns. Gold mining stocks fit within this philosophy because they are productive businesses. Yes, their fortunes are tied to gold prices, but they create value through their operations in ways that physical gold cannot. They can grow production, reduce costs, develop new projects, and return capital to shareholders. They are not inert lumps of metal. By focusing on gold mining stocks rather than the physical gold, I maintain my commitment to productive businesses while gaining exposure to an asset class that can provide valuable diversification during periods of monetary stress. It is a compromise that acknowledges both my preference for productive assets and the potential value of gold exposure under certain circumstances. This is not an approach for everyone. Most investors are better served by ignoring gold entirely and focusing on diversified portfolios of productive businesses across many sectors. Gold mining is a specialized area that requires knowledge, attention, and emotional discipline that many investors lack. But for those who have these qualities, gold mining stocks offer a way to participate in gold prices while still owning productive businesses. That is why they are the only gold position I would ever consider owning. Let me spend a bit more time discussing the historical performance of gold mining stocks versus physical gold, because the data strongly supports the thesis I have presented. Over the very long term, gold mining stocks have outperformed physical gold by a significant margin. This outperformance comes from the productive nature of mining businesses, their ability to grow production, reduce costs, pay dividends, and compound value over time. During the gold bull market of the 1970s, when gold prices rose from $35 per ounce to over $800 per ounce, gold mining stocks dramatically outperformed physical gold. The best miners returned 10, 20, even 30 times investors' money, far exceeding the 20-fold increase in gold prices. The operating leverage of mining businesses amplified the gains from rising gold prices. During the gold bull market of the 2000s, when gold prices rose from around $250 per ounce to over $1,900 per ounce, the pattern repeated. Quality gold mining stocks significantly outperformed physical gold, with some returning 10 times or more, while gold itself rose roughly 7-fold. The outperformance also works in reverse during bear markets. Gold mining stocks tend to decline more than gold prices during periods of falling prices. This is the other side of operating leverage. When gold prices fall, mining profits decline by a larger percentage because costs do not fall proportionally. But here is the key insight. If you buy gold mining stocks at the bottom of a bear market, when valuations are depressed and sentiment is terrible, your returns during the subsequent bull market will be spectacular. The combination of rising gold prices and expanding valuation multiples can produce returns that dwarf what you would earn from physical gold. This is why timing matters so much in gold mining. Investors who bought gold mining stocks at the bottom in 2001 earned far higher returns than investors who bought physical gold at the same time. Both groups benefited from rising gold prices, but the mining investors also benefited from rising valuation multiples and operating leverage. Conversely, investors who bought gold mining stocks at the peak in 2011 suffered worse losses than investors who bought physical gold at the same time. Both groups were hurt by falling gold prices, but the mining investors were also hurt by contracting valuation multiples and operating leverage working against them. The lesson is clear. Gold mining stocks offer superior returns to physical gold when bought at the right time. But timing matters far more for mining stocks than for physical gold because of the volatility and operating leverage involved. Let me also discuss the role of dividends in gold mining investment returns. During periods when gold prices are high and mining is profitable, many gold mining companies pay substantial dividends. These dividends can represent significant contributions to total returns over time, compounding to meaningful amounts for patient investors. Some quality gold miners have established dividend policies that tie dividend payments to gold prices or free cash flow. When gold prices are high and the company is generating excess cash, dividends increase. When gold prices are low and cash flow is constrained, dividends decrease. This variable dividend approach provides income that fluctuates with the business cycle while maintaining financial flexibility. Dividends from gold mining companies serve several purposes for investors. They provide current income that can be spent or reinvested. They signal management confidence in the sustainability of cash flows. They impose discipline on capital allocation by returning excess cash to shareholders rather than wasting it on marginal projects. During the period from 2011 to 2015, when gold prices were declining, many gold mining companies cut or eliminated their dividends to preserve cash. This was painful for income-oriented investors, but prudent given the challenging environment. Companies that maintained financial flexibility during this period were better positioned to survive and eventually thrive. During the period from 2016 to 2020, as gold prices recovered, many of those same companies restored and increased their dividends. Investors who had held through the difficult period were rewarded with rising income as the cycle turned. Physical gold, of course, pays no dividends. It produces no income whatsoever. You must either sell your gold to access its value or borrow against it, incurring interest costs. The income advantage of gold mining stocks over physical gold is substantial over long holding periods. Let me also share some thoughts on the psychological challenges of gold mining investment and how to overcome them. Gold mining is an emotionally difficult sector to invest in. The volatility can be extreme. Prices can decline 50% or more in a year during bear markets. Even quality companies with strong fundamentals experience gut-wrenching drawdowns that test the conviction of their shareholders. The news flow in gold mining tends to be negative during bear markets. Analysts downgrade stocks. Media coverage focuses on losses and layoffs. Message boards are filled with doom and despair. It takes real conviction to buy when everything around you suggests that gold mining is a disaster. Conversely, the news flow tends to be euphoric during bull markets. Analysts compete to raise price targets. Media coverage celebrates the gold rush. Everyone wants to tell you about their mining stocks and how much money they have made. It takes real discipline to sell or reduce positions when everything around you suggests that the good times will continue forever. The cure for these psychological challenges is a systematic approach. Develop valuation metrics and cycle indicators that tell you when gold mining stocks are cheap or expensive. Trust these indicators rather than your emotions or the prevailing sentiment. Buy when the indicators say buy, regardless of how you feel. Sell when the indicators say sell, regardless of how you feel. Position sizing also helps manage the psychology. If gold mining stocks represent 5% of your portfolio, a 50% decline in the sector costs you only 2.5% of your total wealth. That is painful but manageable. You can maintain your conviction and even add to positions when prices are falling if the decline does not threaten your financial security. But if gold mining stocks represent 50% of your portfolio, a 50% decline costs you 25% of your total wealth. That kind of loss affects your lifestyle, your plans, your sleep. Maintaining conviction becomes nearly impossible when the stakes are that high. Most investors in that situation panic and sell at the bottom, locking in permanent losses. The right position size allows you to be intellectually aggressive while remaining emotionally stable. You can make bold contrarian investments in gold mining stocks when the opportunity arises without risking financial ruin if you are wrong about timing. Let me discuss one more topic before truly closing, which is how gold mining fits into portfolio construction for different types of investors. For young investors with long time horizons and high risk tolerance, gold mining stocks can represent a meaningful tactical allocation during periods of opportunity. These investors can afford to wait out the volatility and benefit from the long-term outperformance potential of quality miners bought at cycle lows. A 5 to 10% allocation during favorable periods is reasonable. For middle-aged investors accumulating wealth for retirement, gold mining stocks can provide diversification benefits and potential returns during periods of opportunity, but position sizes should be modest, perhaps 3 to 5% at maximum. These investors cannot afford large drawdowns that set back their retirement plans. For retired investors living off their portfolios, gold mining stocks are generally inappropriate. The volatility is too high for investors who cannot afford to wait for recovery. The lack of reliable dividends during bear markets makes gold miners unsuitable for income-oriented portfolios. Retired investors who want gold exposure are better served by modest allocations to physical gold or gold ETFs, accepting lower returns in exchange for lower volatility. For institutional investors with strict mandates and benchmark constraints, gold mining is often impractical regardless of opportunity. The tracking error relative to benchmarks, the volatility, the specialized knowledge required, all of these factors make gold mining difficult to implement within institutional frameworks. This is one area where individual investors have an advantage. The point is that gold mining stocks are not appropriate for all investors at all times. They are a specialized opportunity that makes sense for certain investors during certain periods. Understanding your own situation and risk tolerance is essential before allocating capital to this sector. I have now shared everything I know about why gold mining stocks are the only gold position I would ever consider owning. The key insights are these. Physical gold is an unproductive asset that produces nothing and cannot compound value over time. It is a bet on fear, an insurance policy against disaster, and historically a poor investment compared to productive businesses. Gold mining companies are productive businesses that can grow, reduce costs, pay dividends, and compound value over time. They provide exposure to gold prices with a potential for superior returns during favorable periods. The best time to buy gold mining stocks is during periods of sector distress, when valuations are depressed and sentiment is terrible. The worst time is during periods of euphoria, when valuations are high and everyone is bullish. Quality matters enormously. Focus on miners with low costs, strong balance sheets, quality assets in stable jurisdictions, and capable management. Avoid the temptation to buy cheap, low-quality companies, hoping that rising gold prices will bail them out. Position sizing should be modest, limiting exposure to 5% or so, even during periods of maximum opportunity. This allows you to participate in the upside while containing downside risk. A systematic approach based on valuation and cycle indicators helps overcome the emotional challenges of investing in this volatile sector. These principles have guided my thinking about gold exposure for decades. They explain why I have criticized physical gold as an investment while acknowledging that gold mining stocks can make sense under the right circumstances. If you remember nothing else from this discussion, remember this. The form of your investment matters as much as the asset class. Gold mining stocks are businesses that can compound value. Physical gold is an inert metal that cannot. That fundamental difference is why gold mining stocks are the only gold position I would ever consider owning.